All right. Good afternoon, traders. Happy Tuesday and welcome out to the Tradespoon Active Investor Workshop Series. My name is Scott Beck. I am the head trading coach. It's a fancy title, right? Head trading coach here at Tradespoon. And I will be your host. Today, we are having a discussion on options, always one of my favorites. Well, they're all my favorites, actually. Everything but fundamentals. I just have to muscle through that, right? Fundamentals, I'm like, everything else, technicals, psychology, planning, strategies. Oh, I love it. Long time no see indeed, Chet. Good to see you. Glad you can make it. Hello, Phil. Same with you. Hello again to you, Faust. Excellent. Always glad to have some usuals. Hopefully there's some new people. If you're new, say hello. If you're just checking out Tradespoon and some of the things that we do, great. Glad to have you. I hope you decide to come on in and check out what we do on the inside. It's even better. It's hard to imagine, but it is. So again, my name is Scott. Say hello. Give me your questions, your insights, your opinions, your feedback, whatever. I like these to feel more interactive than just me standing here talking at you. Good afternoon, Faye from Colorado. You're next door. I'm in Utah. As a matter of fact, we are mountainous neighbors. Good to see you. Thanks for coming out. I've been trading for a while, teaching for a while. That's my background. Short background. I do need to remind you very specifically that trading options in particular, this presentation will definitely involve options, can involve substantial risk, may not be suitable for all investors. Please read characteristics and risk of standardized options prior to investing in them. Evaluate any strategy prior to use to understand risk and suitability. You must be aware of the risk, be willing to accept them in order to trade in these markets. Tradespoon and myself are not investment advisors. We're not registered with the SEC or FINRA. It should not be assumed that future trade picks will be profitable or will equal past performance. The information in this presentation is provided solely for general education and information purposes. Any strategies discussed, including examples using actual securities and price data, are strictly for illustrative and educational purposes. In order to simplify the math, commissions, fees, margin, interest, and taxes have not been included in the examples used in this presentation. Those costs will impact the outcome of your results, should be considered. Lastly, I and/or the team of Tradespoon may have a financial interest in the securities presented on the trade picks. Vlad Karpel, Tradespoon founder, is also an investor and a consultant of AOS Inc., which does business as Trading Block, Money Block, a FINRA, and SIPC member broker-dealer firm. Tradespoon and AOS are not affiliated companies, and each firm's material is not endorsed by the other. Let's jump in. Credit spreads. I don't have slides. The pandemic has changed my delivery style in these active investing workshop classes. But during the pandemic, I said, you know what? I'm going without slides. I'm winging it. I'm going to wing it. Sometimes I don't even know what the presentation is until 30 minutes before. And today is one of those days. So we are going to just go on the fly and talk about credit spreads. So let's start with this. What is a credit spread? Right? What is a credit spread? What am I trying to accomplish with a credit spread? I'm going to use the SPY as an example. We've been talking about our market forecasting, our market posture, and we said, you know what? It's feeling. I didn't draw that the way I wanted. It's feeling okay. We definitely busted up. We thought maybe it was going to get going back here. And then we had some Fed speak and some Russian stuff. And then it looks like it's turning. So yeah, there's some mixed sentiment still. We still have some uncertainty about this market. We certainly have to respect that, pay attention to that. But certainly if there was going to be a time for a bullish trade, it is bouncing off of a support level. And that seems like what we've done. So we're going to use this as an example of a credit spread, a bull put spread. Bull, I'm bullish. I think it's going up. Puts, I'm using puts to create the spread. Spread, it's a spread. Bull put spread. It's pretty easy, right? versus a bull call spread, which is a debit spread. I also have a bear put and a bear call. One is debit, one is credit. And that introduces you to the family of vertical spreads. So under the umbrella of vertical, you have a couple of different ways you can go. Credit versus debit. I have a bullish credit spread and a bullish debit spread. And I have a bullish or a bearish debit and a bearish credit spread. I have call spreads versus put spreads. One is bullish, one is bearish. They both can go either way. So when it comes to the world of vertical spreads, you just want to get comfortable with either side. When it boils down to selecting, and I cause controversy with this, and I don't know why, but I always tell people, mathematically, I can show you, right? And that's all that matters. The numbers don't lie. But the difference between credit and debit spread is a preference. There is no, right? Some people are like, oh, when the implied volatility is high, I do credit spreads. And when the implied volatility is low, I do debit spreads. Doesn't work. That didn't help you. I promise it didn't. When the implied volatility is high, I do want to be a net seller. I do want to have a what would be considered a negative vega and a positive theta. And that's what a credit spread tries to do for me. However, not always. So just because I do a credit doesn't mean that I'm necessarily a one way or the other. With a debit spread, your risk is defined. You know what you're risking. Same with a credit spread, right? Exactly the same. With a debit spread, you pay a certain amount. That is your risk. You cannot lose more than you buy in a trade. Right? That is something that you if you buy an option, you can't lose more than you paid. So you're right that a debit spread has defined risk. Your reward is the other side. So if you take the width of your spread minus the debit, that equals the maximum risk, or excuse me, the maximum gain. So you have defined risk and you have defined reward on both sides defined. Okay, now let's look at a credit spread. What do I start with? I start with a credit. So instead of starting with what is your maximum risk, you're starting with what is your maximum gain. When I sell something, what I sell is the max. I can't make more than that. I sold it already. I collected a premium, and that becomes the maximum potential return. So to find out the risk, you do exactly the same equation. Width of the strikes minus the debit equals max gain. The width of the strikes minus the credit equals maximum risk. They're just inverse and mirrored images of each other, right? Is that a sloppy descending head and shoulders? Yeah, see, it's hard to see any patterns in here. You definitely had a head and shoulders back here. Boom, 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 boom. There's your neckline. Boom, there's the break. The interesting thing is this distance actually completed the pattern. The distance between the neckline to the head tends to be what we would extrapolate for our projection to the downside. And you can see we actually got that amount. Now, from this point, what have we seen? Gosh, I don't know. I mean, where would you even put the shoulder? Although I can tell you right now, when it comes to price formations, price patterns, double tops, triple tops, head and shoulders, inverted head and shoulders, flags, pennants, wedges, etc. It oftentimes feels a little bit like cloud formations, right? And you're like, oh my gosh, do you see that frog? And someone else is like, frog? What are you talking? I see a unicorn, right? In fact, a double or triple top and a ascending triangle look exactly the same until it breaks either resistance or support. So very interesting stuff. Good question. Good lively discussion about the technical principles. So what are we thinking here? We're thinking that the line of consolidation broke and it popped up. Now, here's the thing, is it tried and failed, but is still holding above this bottom low, right? So this is what makes it a kind of an interesting read, because if I consider that to be a low, then technically that's slightly lower. So it's like the sellers did a little bit more, but not that much, right? And both of those are definitely still higher than those prior lows where we touched that 10% correction range. Makes sense? So quite honestly, you could build a technical argument on either side. It just really depends on your own personal trading rules. Do I feel like this is as bearish as or even neutral as it was? No, I think we've definitely stabilized. You know, definitely, I definitely think if you're bullish, right? If you're bullish, this is when you would look to enter. If you're not bullish, then you're probably going to sit this out. Does that make sense? But certainly this is bouncing off of a low higher than this one. Now, if we include, let's add a little perspective. Let me go here to SPY, and then we're going to get into the strikes, of course. We're starting to build it. We're laying the groundwork. Sell a put, buy a put. The selling of the put is the driver, right? That's the driver. That's what creates the income. The buying of the put. Now, some people are like, oh, you buy the put for insurance. Well, I mean, yes, but also no, right? Yes, it does define the risk so that you can only lose so much. But at the end of the day, I don't want to lose everything, right? I still want to exit the trade if I get a signal that says, hey, you know what? This isn't going the way you thought. This doesn't look like it's going up. It looks like it's going down. And if I get to that point, I'm going to say, well, if I think it looks like it's going down, do I still want to be in a bull put spread? Yeah, probably not, right? Probably not. And therein starts to create, it's one of my, I say this all the time, one of my most useful trading rules, almost, it's just borderline a common sense statement. But it says, if the original reason for getting in a trade is no longer valid, get out, right? Well, what's the original reason for getting in the trade? It's a bull put spread. The original reason is you're bullish. You think the trend is up, or at least there's enough strength from the buyers, from demand, that prices are going to go higher. Great, you're bullish. Probably, hopefully, you're at or near a support level. And that support level is going to hold and bounce to a higher resistance level. Okay, that makes me bullish for sure. Whatever else I might look at, an oscillator, a moving average, some type of candlestick that tells me, yeah, this looks pretty okay, great. But my basic assumption is I'm bullish. Why am I selling a bull put spread? Well, because the volatility is still a little bit high overall. And that tells me that options are a bit expensive. You can see up here. And if the options are a bit expensive, I don't want to be a buyer, right? I don't want to buy expensive options, because if I buy an expensive option and the stock goes up, let's say, and the volatility drops, and let's say it actually takes a little while, it goes here, and this drops down here, what's happening? If you buy an option, time, theta, we'll call it, is working against you. Volatility, vega, right? Vega is working again. I'll finish that, because you're like, what do you mean? Is that Thursday? No, that's vega or theta. This is vega. So if I think implied volatility is dropping, I want to be vega negative. If I think that it might slow down or that the options are expensive, I want to be theta positive. How do I get a theta positive, vega negative trade? Now, what did we start with? Delta. What direction do we think this is going? Up, bullish. which means delta E needs to be positive. What trade exists where I am theta positive, delta positive, and vega negative? It is a bull put spread. Awesome. Okay, so hopefully you're getting a sense of why. Why do we do it? That should be important. If the options are cheap, if the implied volatility is very low, down at 15, your credit spreads are going to pay garbage, nothing. There's nothing there. It's trash. Buy an option when they're cheap, sell them when they're expensive, right? That's the market makers are literally telling us, hey, here's what you should be thinking. Implied volatility is high, they've had mostly buyers. So what do I want to do? Be a seller. Implied volatility is low, everybody's been selling. What do I want to do? I want to buy, because the market makers are telling me, hey, it's better if you do this. It's better if you do that. Awesome. Okay. So we are now in agreement, hypothetically speaking, that we're bullish. We think the market's going to bounce, and we think implied volatility is high. So what does that lead us to? Leads us to want to build a bull put spread, right? What do I do when I do a bull put spread? I'm going to pick an initial strike price. The first strike price that I select is the short strike, or the one that I am selling. I'm selling something I didn't own. I don't own the strike I'm going to sell. I am creating that contract. Or rather, I am asking the market makers to create that contract by buying it from me as a component of the spread. So if this is where we are now, I have a few choices. I could sell in the money, which would be up here. If I sell an in the money put, that is ITM. What am I doing? I'm selling intrinsic value, not time value. Intrinsic. So I'm pretty reluctant to do that. I don't personally tend to sell in the money options. Then we have this range through here, right? This is at the money. I tend to be more of an at the money seller. You're going to get more bang for your buck, a little bit bigger premium. And then we have down here, we have out the money. This is where you have a probability trade. If you ever hear people say, I'm a high probability trader, they're looking for a greater percentage that it stays out of the money. I tend to consider myself more of a swing trader, where I'm a little more interested in a combination of reward to risk coupled with probability. So for me, I'm going to exit the trade if it goes wrong. Whereas someone who does an out of the money might come down here and say, I'm going to sell a 430, buy a 425, and my expectation is it's going to stay above that. I'm just going to let it ride, right? So you're going to get a smaller credit, but there's a higher probability of success. So if I go in the money is the highest. The probability is the lowest. If I go out of the money, probability is the highest, but money is the lowest. Whenever it's interesting how often I've been talking about this in sessions I've been having as I work with traders. There is a chess game happening, right? That's a metaphor I like to use. A good trader should be thinking three or four moves ahead at any given time. Always proactive, right? Always having 2 or 3 possibilities of, if then, right? If it goes up, I'll do this. If it goes up a little, I'll do that. If it goes sideways, I'll do here. If it goes down, I'm gonna, right? One of my favorite things to tell people is, if you want to be right, have more than one idea of what might happen. Okay. Now, let's further that chess metaphor. What should a chess player's most important objective be? I actually, probably 15 years ago now, I used to teach some trading boot camps. And I had all kinds of people come through, but I actually taught I don't know if he was professional. Probably it was like a grand master chess. He had attained a certain level playing international tournaments. I'm like, oh, I love it. A chess guy. I said, what's your most important objective? You know, my thinking was this guy would say, oh, I don't think 3 or 4 moves ahead. I think 5 or 6 moves ahead. I'm way ahead of the rest of you people. But it was quite the opposite, but even better for my purposes. So he said 3 words. You want to know what my most important job is playing chess? Protect the king. Right? Protect the king. Cash is king. We all know that. So in trading, what's your most important job? Protect the capital. Protect yourselves at all times. So, right, one of the things we like about spreads is they are a defined risk trade, especially if we build them the right way. But the last piece of that chess metaphor, analogy, whatever you want to call it, is know your pawns. Know your pawns. In any scenario that you face trading, you have to be willing to risk something, right? You will be risking something. The question is, are you choosing what you risk or is it being chosen for you, right? If you put a tight stop, you keep your risk low, but you risk getting stopped out of the trade prematurely. If you put your stop too low, you won't get stopped out prematurely, but you risk more money. If you don't put a stop, you never get stopped out prematurely. And you also never protect yourself from big downside moves, especially if you're not prone to get out. I could go through a scenario after scenario after scenario where it's like, okay, well, what are you focused on that you want? What are you willing to sacrifice to get that? And do you recognize what the pawn is? Okay, so let's talk about the pawn here. If I sell intrinsic value, I'm more bullish, right? You'll get more money. It's more bullish, but it has to move. If it doesn't move, you don't make that money, right? It's that simple. If I sell at the money, then I have, right? If it doesn't move at all, usually if I sell at or slightly out of the money, it doesn't have to move. It could stay right where it is. I expect it to move. That's why I'm doing the trade, because I'm bullish. But if it doesn't move, I'll be okay. Not great, but I'll be okay. Now, an out of the money option, it could go against me and I still don't have to do anything. So those are the probability factors. So would you rather have higher probability where you're risking 450 to make 50 cents? Ooh, those reward to risk scenarios can be devastating. Would you rather, risk $1 to make 4, but you're hardly ever right? Or would you rather be somewhere in the middle? I tend to find myself Goldilocksing that scenario and going somewhere in the middle. Do you usually want a 50% delta? So if you're selling at or out of the money, then yes, you're probably going to sell a 40 or a 50 delta, right? Which is at or out of the money. So in this scenario here, I might sell the option right at the bottom of today's candle. That probably puts me around 440 to 445. Somewhere between 440 and 445 would be the at the money. If you're doing actually, I'd probably say 445 would be the at, 440 would be a little out. If you're doing a probability trade, you're probably going to sell the 430 or the 425. Right now, that's so when you're selecting strike prices in a credit spread, you don't pick them at the same time necessarily, right? Start with the one you want to sell. Do I sell in the money, low probability, more money? Do I sell at the money, somewhere in the middle? Do I sell out of the money, higher probability, but my credit's going to be much less? There is no right answer. There is only your answer. Right? That's it. There's your answer. You decide. But these are the considerations you should be making in order to decide which one do I want to sell. Okay, so that's selecting your short strike. Let me know if you have any questions about that. I'm going to erase my beautiful lines Gonna change my color because I like this light blue better than I like that brown. So let's just say we're gonna go pretty much right at the money or slightly out of the money. We're gonna go right about, I would say, here, the 440, right? So, or excuse me, the 445. So the 445, that's gonna be my short strike. When selling in the money isn't risk of assignment higher. That's a great point, Chet. And the answer, if you're trading American style options, is yes. These would be American style, SPY. If you were trading SPX, no. If you're doing any kind of an index, they are European style, right? And they're much more rigid and they can only be exercised at expiration. So yeah, if you're doing credit spreads, now here's the thing, it's unlikely. So let's pause for a second and talk about assignment and exercising. So I'll work with people and they're like, oh, my option went in the money. And they're just like, it's like there's this looming, now that it's gone in the money, somebody's going to exercise it. I've bought thousands, if not tens of thousands of options over the years. And not one time have I exercised it. I don't buy the option because the second it goes in the money, I'm like, okay, let's hurry and buy the stock. If I do that, I will pay actually quite a bit more than I would have paid if I would have just bought the stock at the time that I first started looking at it, right? Because I'm paying that time premium. And the second I exercise, I sacrifice whatever time premium is left. So there are two scenarios where like 96% of assignments occur. Obviously, the first one at expiration. There is no time left to sacrifice. So now, if there's any intrinsic value at expiration, somebody's going to exercise it, right? Don't let me forget to talk about the three scenarios at expiration for this trade so we can have a sense of what to do with it real quick before we end. So at expiration, if it's in the money, it's going to be auto exercised by a penny. When I started, it was a quarter, I think, and now they basically, if it's a penny in the money, your broker's going to exercise it for you, period, right? That's going to happen. The other time that there will be an increased level of assignment and exercising would be around dividends, especially special dividends, right? Where they're like, oh, you know what? We're gonna declare a dividend real quick. Well, the second they declare that dividend, remember that options have no rights, but that stock is gonna drop by that amount when that dividend occurs. So if they're like, hey, we're gonna pay a $2 dividend in 3 weeks, options are gonna adjust and the calls are gonna be worth less and the puts are gonna be worth more as soon as they announce that dividend. So if you own a call, you're like, shoot, you would say to yourself, I'm going to lose out unless what? Unless I exercise my option and take control of the stock. Okay. But other than that, but yes. The answer to your question is there is a higher risk of assignment if you sell an option that is in the money. Now, what am I going to buy? So a lot of times people will just go $5 wide, and there's really nothing wrong with that, right? Boom, I buy the 440, and now I have my bull put spread. Okay, I have a tendency to go a little lower. My thought is, if it breaks down into this range, I'm probably going to close the trade somewhere in here. I'm probably going to go down to the 435 and maybe even the 430. Why? So let's go build this since we have it, and then let me show you exactly why that is. So I'm going to go into the Analyze tab here. I'm going to do a vertical. I'm going to go out a month. I'm going to go to the March. And let's start by selling the 445. I mean, I could do $1 wide if I want to. The margin requirement is much less. I'm on the hook for the distance between these two strikes. minus the credit, which is the maximum risk. So if I were to look at this option here, this spread here, $1 wide, 39, that means that my risk, therefore, is 61. So I need $61 for every contract that will produce me $39 of income or credit. That's going to be my margin requirement. And you'll be like, well, wait a second, Scott, it says 1,000. Well, yeah, because I'm going to hold 61 of my own money. And then they're going to take that 39. They don't give it to me and say, hey, here's your cash. Go spend it, buddy. They put it in the margin requirement, like an escrow, right? That's not my money. That's why I think it's funny when I hear people say, oh, I like credit spreads better because I like putting money in my account on day one. That's not really in your account, you know, like it's there, yes, but it's not yours. You can't withdraw it. You can't spend it. You can't trade it. It's being held in escrow until the trade is completed, until you either let it get to expiration. Let's talk about expiration real fast here, and then we'll go back and then finish up with the, so hopefully you already have a better sense of the short strike. Now we're talking about the long strike, and there's the presentation. How do you select the width and the strike prices that you go for? So this is one of the considerations, is the margin requirement. Now, at expiration, there are 3 places for the spread to be. A, out of the money. On a credit spread, out of the money means it's on a bull put credit spread. Out of the money means it's gone above your spread. If it's a bear call, it means it's gone below it. So it's out of the money. It means it's done what it's supposed to. It went the direction you thought it was going to do. What are you going to do? Nothing. Nothing. It expires worthless. You don't have to do a thing. It expires worthless on expiration Friday. You keep the maximum credit and you walk away whistling a happy tune. Okay, that's scenario A. Out of the money, maximum profit, no action required. Okay. Scenario B, it finishes in the spread. Now, in this case, I have a $1 wide spread. So if it finishes right at 444.50, it's in the spread. Now what? In the spread has some danger to it. The danger being, if I don't do anything, the 444 put that I own is worthless. The 444 put at expiration isn't worth anything if the stock's above that. The 445 is now in the money. And if it's in the money, it's going to be exercised, right? It's going to be exercised unless I what? Shut the trade down. They won't exercise it till after the market closes. Automatic assignments and exercise don't occur until after the market is closed. So you have all day to complete this task. But if it's in the spread at the end of the day, you want to buy back. Now, in this case, it's not really buying back the spread. A lot of people think it is, and it gets them in trouble because if you buy back the spread, what you're doing is you're buying back what you sold and you're selling what you bought. The problem with trying to sell what you bought is you're trying to sell an option that's worthless. So you're packaging a worthless option into a closing trade, and it will prevent you from actually closing your trade. If you've ever traded credit spreads and you couldn't get out at expiration, it's probably because you were trying to get out of the whole spread. What do? You only need to buy back the obligation. The option that you bought gives you the right. That right is worthless. Great. Nothing we can do there. The option that you sold is your obligation. You are obligated. Somebody will force you to uphold that obligation at the end of the day if you don't close it. So what do? I buy it back. So if I put this spread on and the stock is at 444.50 at expiration on March 18th, that long put's going to have 50 cents of intrinsic value. That's what I'm going to have to buy it back for, 50 cents. Right? At the end of the day, there's no more time. So it's just like, great, shut it down. If I sell it for 39, I buy it back for 50, I lost money, but not much. 10 cents, 11 cents, right? I was willing to risk more. I didn't, but I definitely don't want to expose myself to the possibility that the stock gets put to me and then over the weekend it falls and I end up with a significantly higher a loss level than I was anticipating. Also, this is 10 contracts. That's 1,000 shares of a $445 stock. That's a scary proposition. I don't want to have to buy that. Now, even if I don't have the money, will they buy it? Yes. And then I'll have a margin call, and then I'll have to sell the stock, and a lot of the control is taken out of my hands. I want to stay in control. So if there's any danger of the stock being in the spread at expiration, that is when you absolutely have to take action. Okay. Scenario C. So A was out of the money, max gain, no action required. Scenario B, in the spread, action required, or you will be assigned, likely. But you don't have to take that action until right at the end of the day to give it whatever prospect you want to give it. Scenario C, in the money. And I know you're thinking, in the money, right? We're in the money, right? It sounds good. I want to be in the money. No, you don't, because you're a seller. You're a net seller. You want it to be out of the money and expire worthless, not be in the money. If it's in the money, that means it's gone, in this case, below 444. Below that, which means that the option you own has intrinsic value and the option that you bought has intrinsic value. That means that at that point, you're at maximum loss. If you are in the money at expiration day, you're now losing $1, the difference between the two. Somebody out there says, hey, I'm going to force you to buy the stock for, let's say the stock's down at 440. Somebody out there has the right to sell you a $440 stock for $445, and they're going to take it. They're like, hey, here's my stock. Give me my 445. And you're like, okay, but I'm going to turn around because you're obligated to the 445. You have rights from the 444. I have the right to sell it to somebody else for 444. What is my loss? $1. That's the width of the spread is what creates what your risk level is going to be after you take into consideration the credit you collect, right? Because if I'm risking $1, but I already collected 39 that they're holding, then the actual loss amount potential would be 61 cents. And that's what would happen. So I can either A, buy the spread back for $1 and be done with it, or I can B, wait for it to get to expiration, and it goes through a process that is known as same day substitution. They sort of do the Peter pays Paul behind the scenes. It's not like the shares enter my account then leave the account. They basically pass through, and I'm done. I'm done, but I'm done with maximum loss. So certainly I'm never excited if it goes in the money. So I might have a rule that says, hey, if this thing breaks below, 445 and closes there, I'm gonna shut it down because I don't want to take that loss. Okay, let me know if you have any questions about any of those logistics we've gone through. Now, do I have to just go with the default? This is what a lot of people do. They just go with the default, one wide. No, I don't. In fact, I said I might go down at least to the 440. Let me actually put this up so you can see this. So you can see here, I don't have a lot of room between these two. It's like all happens right there. If I decide I'm going to go to a 440, you can see my credit gets bigger and the nature of this trade closes. And you could be like, well, Scott, your risk is significantly higher. Well, yes and no. Yes, the potential for risk is higher, but I'm going to exit the trade if it goes wrong. I already said that. I already said if this thing drops down to 441, I'm out. So that's right here. Now, time is working against me, so I would have to be aware of that there is a time element that is working against me. So I would need to account for that, but you'll notice that my maximum gain, 10 contracts, 180 per contract is 1,800, sorry, 180 per contract, $1,800. So I have the ability to make 1800. What does it have to do to make 1800? Stay above 445, which is already where it is. So if it were to go up, I can make 1800. Now let's say that I'm planning on making 80%. If it gets to 80%, I take it. So that's 1800 less 360. So that is 1340, right? No, 1440. So 1440 equals 80%. So I'm happy with 1440. That's my so my maximum gain, yes, is 18, but I'm not thinking, oh, I'm going to get there and let it expire. I'm thinking, hey, if this thing gets up and I've made 80%, there's a very good chance I'm going to take that, walk away. I might let it go depending on how high it's moved. But let's say my expectation is 1440 for a gain. Well, what am I willing to lose? Well, I'm going to lose. I'm going to actually set this level in. Let's go 441. I'm going to lose 300. Well, kind of. Okay. If it takes a week to be wrong, I'm going to lose 375. So let's just round up to 400. 400 is my risk. 1400 is my gain. Right? So I have a favorable reward to risk ratio. Right? A favorable reward to risk ratio. So it's not a high probability scenario, but it's pretty high. If I have an uptrending stock and all it has to do is go above where it is now, it doesn't have to make a move to 455. If it gets to 449, but it goes all the way till expiration, you can watch how this thing, time just keeps on helping. Boom, 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 boom. And then it's just right at the end, especially, you can see it's the last week. The last week, it really pops in this area. If I want 80% early in the trade, let's say the first 2 weeks, it's got to make a pretty big move, right? It's got to get all the way out here to, gosh, I can't even get there. 14, 40, 472. 472. If I want 80%, it's got to get out to 472. Is that possible? Well, that's right back up here. So yeah, I would say that's possible. So if it makes a big, strong move up, I get my money, my 80%, shut it down, walk away. If it goes slowly and just grinds sideways at 458, okay, I can live with that too, right? A sideways grind is fine. If it gets to 458, but it takes, well, if it only takes 2 weeks, I'm only going to make about half my money. So there's a good chance I would still try to push it to see if I can get a little bit more. Now, I could even go a little wider. And now the reason I would do something like this, here's what I want you to notice. At 440, I have a crisscross level. Now this crisscross level here, to the right side of it, time is working for me. And this moves up as time decays. But to the left side of this crisscross, time moves down, and it hurts me the longer I'm in the trade. So that's a pretty pivotal place where theta, you can see here's my theta, goes from positive to negative. I don't want to be theta negative. I want time on my side. Well, why would I build a wider spread? Now, let's leave this here for 1 second. And let's say that 500 is our position size, right? I don't want to risk more than 500. Well, this is about right, 500 bucks. Risking 500 to make 1,400 approximately, almost 3 to 1. If I change this to 435, I'm risking too much now here. I need to do fewer contracts, right? So I would maybe come down here and do 6 contracts. But I'm getting 6 contracts at 332. That gives me a maximum gain of up around 2,000. Now, if I'm getting 80%, I'm getting 1,600. Same risk, $500. This time, though, I'm making a little bit more money, 1,600. Now, what else happens? My margin requirement's higher. My margin requirement is going to be 6,000 versus, should have left the other one up, versus, how many of these did I say? 8 of these? 10 of these. 5,000. So it's not a ton more, but it's a little bit more. So for me, I don't just take the first strike below the one that I sell. I'm willing to go a little wider. It'll collect more credit, so I'll do fewer contracts. These days, it's not as much of an impact, but commissions are less. And if possible, I'm going to try to build it so that my trade stays theta positive for the entire trade. So that as long as I'm in it, every day it's a little better. Every day a little better. Time is the most consistent variable. It's a constant. Price goes up and down. Volatility goes up and down. Interest rates go up and down. Time always ticks at a constant rate. So if it's a constant, I'd like to have it in my favor. Now, what's the pawn? I don't get maximum gains. I don't get unlimited upside potential. If this thing all of a sudden just smashed up and got to 500, I can't make more than a certain amount. If I bought the calls and it went up to 500, I'd make so much money. Okay, so then just ask yourself this question. How good are you at picking over and over again stocks making enormous moves? And if your answer is not great, then again, what's the pawn? Well, I'm willing to risk not picking huge moves all the time, and I'm sacrificing the upside potential that would give me in order to give me what? Higher probability of success, more consistent returns. Right? Think of your trading like a business. I say it over and over. Think of it like a business. And think, what's the sustainable model that we can do over and over and over and over again and again? So that would be an at the money spread. You saw with $1 wide, you saw 5 wide, you saw 10 wide. Real quickly, let me just knock out a out of the money. So let's say out of the money, I'm going to come down here to 430. I'm thinking, you know what? Look at this support level at 430. We tested it back in September. We tested it again here in late January, early February. It's going to hold. I'm going to sell at 430. Okay. And let's start with just a couple wide. Let's go 430 by 428. That's not terrible, right? I mean, it's 46 cents credit on a $2 wide. I mean, I've seen people who will do 15 cents on a $2 wide spread. I mean, 15 cents on a $1 wide. This is better than either of those, but not by a ton. But you'll notice, as long as it stays above 441, we make money. Over and over and over again, right? Let me, I actually think we'd get a little bit more, maybe something like that. Now, if it breaks all the way down here at 429, I would still want to, personally, I would want to close the trade if it broke the downside, because the risk down here is so potentially enormous. Can I post the agenda? You know what? The agenda is the title, Picking Strikes for Debit Spreads. I don't have slides, but there will be a recording posted. And you can definitely watch it again and just kind of go through it. But yeah, I don't have slides, so I apologize. It's all kind of based on what we see for market conditions, what stocks we can use as examples, etc. Now, well, if it drops down here, I'm gonna lose somewhere between $360 and probably $400. And if I'm right, the most I'll make is 500. However, I would expect to get, I'm less likely to close at 80%, but even at 80%, you're talking 400, risk 4 to make 4. So this is a 1-to-1 scenario. That means I need to be right at least 60 to 65% of the time. 60 to 65%. If you do like even worse, if you go where you're even further out of the money, and you're doing, risk 3 3 to make 1. You've got to be right like 80, 90% of the time. It's very important that you see both sides of the coin, that it's both reward and risk and probability of success and what's required based on the reward to risk profile you're establishing. So if I'm doing a directional at the money spread, I'm looking to get 2 to 1 or 3 to 1, and I only need to be right 40 to 50% of the time. If I am doing an out of the money, I'm probably going to be at best 1 to 1, so I need to be right 60 to 70% of the time. That might go into how you go about building and selecting your strikes. But selecting your strikes is about creating the level of risk that you want. The width of the spread will help to contain the risk and define the margin requirement. If I'm doing a probability spread, I'm usually just going to go 1 or 2 wide, stick it on, let it sit above it. I have much more of a tendency to do directional trading where I'm calling it to move up. I'm selling at or slightly out of the money. I'm going to get a better reward to risk ratio, still going to be willing to close the trade, and I'm still going to get a good amount of profit if I can achieve 80% of max gain. Whew, so there it is. Hopefully you have a better understanding of what credit spreads are, what our thought process, what we need to do at expiration, how much time. How much time? I'm typically going to go 4 to 6 weeks. Some people love the weekly credit spreads because you make your money faster, but they're also harder to control the risk. So again, trade-offs and what is the pond, knowing what you're focused on. I'm focused on an easier to manage risk, so I'm going to go a little further out in time. If you're focused on making money from time decay right away, you'll sell the weeklies, and then you'll find, they can be hard to manage when they go against you. And there it is. So like I said, this will be posted. You can watch the recording again. If you want to take some notes, write a few things down. Like I said, I love credit spreads. I've traded credit spreads for a very long time. Yeah, credit spreads. Join me in 2 weeks for another one of these active investor workshop series. If you're already a subscriber and you're inside trading rooms, we got some fun this week. So I'll be here tomorrow morning and tomorrow afternoon. I'll be here again Thursday morning and Thursday afternoon, and then I'll wrap up my week on Friday, and then Vlad will be back to shut her down on Friday afternoon. So thank you very much, everybody, for coming out, hanging out with me today, enjoying a little conversation on spread trading, credit spreads in particular. How do we determine the short? How do we then determine the long and what the width of that spread should be? There's no formula. There's just different considerations. Based on your considerations, you'll find what works best for you. Have a wonderful rest of your day. And as always, happy trading.